The nation's housing markets are set to reignite with a stimulus package focused on winding back lending restrictions, lower interest rates. Those are going to fuel economic growth, but there's also going to be tax cuts coming in and increased infrastructure spending. While these positive moves are going to instill confidence, there are still some underlying issues that need to be discussed. And that's what I'm going to chat about in this week's Property Insider Show with Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Welcome, Andrew.
Good day, Michael. How are you?
Good. Well, it's really been an interesting week. The Morrison government's been re-elected.
Yes.
Investors are now breathing a sigh of relief because there's no change to negative gearing or capital gains tax. Small business owners can expect tax cuts, and that's good for them. Mum and dad investors are going to get a tax refund. So things were starting to look good for consumer confidence and for our property markets. And then in the last couple of days, APRA started to loosen the screws, making it a bit easier for banks to lend. And now we're waiting for the Reserve Bank to lower interest rates. But just recently, the Reserve Bank Governor, Philip Lowe, gave the clearest signal yet that interest rates are going to get cut next month, suggesting higher unemployment was now preventing inflation targets from being met. And he now thinks interest rates are appropriate. In fact, Andrew, he was hinting that we could actually have 2 interest rate cuts. What do you think about that?
Well, it's certainly been a big week in property, hasn't it, Michael? As you suggested, firstly, we've now got those, fear-generating tax changes promoted by the ALP off the table with the re-election of the Morrison government. We have also the macro stimulus of income tax cuts set to now be introduced as planned before the 30th of June. And, we also have some smaller packages in terms of impact for first home buyers being able to borrow more. But of course, the icing on the cake, clearly, as you've said, is now a clear relaxing of the questionably tight interest rate and lending policies of the last 3 or 4 years. Clearly now the Reserve Bank is set to cut interest rates in June. As you said, perhaps that won't be the first cut. It may be followed up by another cut. We've also seen, Michael, a raft of banks reducing interest rates over the last week, and they'll obviously be prepared to cut rates again and pass the official rate cuts on. So a big week for the housing market, a big week of positives for the housing market. This will help to clear the fog, but it will be a gradual process nonetheless.
Well, Andrew, what factors do you think the Reserve Bank took into account when it met and decided to change its policies?
Well, the big 3 macro factors that the Reserve Bank have been looking to in terms of its loosening of monetary policy to record low levels. Firstly, of course, wages growth. Importantly, wages growth typically is generated with lower interest rates because that puts more dollars in the pocket of consumers who then consume and create economic growth. And the second factor is inflation, which as a result of increased consumption pushes up prices as the capacity to meet that new demand is constrained, and higher prices, of course, lead to higher levels of inflation. And the other factor there, of course, is the unemployment rate, jobs market. Now, those 3 factors typically have worked in sync through monetary policy increases or stimulus and constraints, but this time it hasn't worked. We've had a jobs market now at the lowest levels since the mining boom, but that's failed to ignite incomes growth, which of course has failed to ignite inflation. The Reserve Bank has finally given up on its theory that eventually low unemployment would lead to incomes growth. Incomes growth is stuck in first gear at best, and inflation, of course, is at similarly low levels. Reserve Bank shouldn't have been surprised at this because it's been happening everywhere else in the world, but finally the U-turn has happened. They are going to cut rates. And I think, Michael, one of the biggest factors here is the next GDP numbers to be released by the ABS will be on the 6th of June, which is the day after the next meeting of the Reserve Bank. And I think given how we've seen a severe decline in the trend of GDP growth down to just 0.2% over the December quarter, I think that the Reserve Bank is going to preempt any concerns of if we get another flat result or even a negative result over the March quarter on those June 6 figures. I think they want to get ahead of the game and be seen to be acting to stimulate economic growth now or stimulate GDP. And of course, if we look just quickly at the numbers, the wages index has stuck at its level over the past 3 months of 1.3% growth, even though that's higher than where it has been at its trough over the past year or so. There's still no upward movement to gain confidence that this will be getting back to the previous levels. Inflation, of course, remained low. Underlying inflation fell sharply over the March quarter. And of course, the unemployment rate has now risen over 3 consecutive months. Still quite low, of course, nothing to be overly alarmed about. But the trend is clearly upwards for the unemployment rate, and likely with the shakeout in the residential construction industry now acting to decline the labour market, to shed jobs, and also the property industry. And the downstream effects of this will obviously be a negative for jobs growth and likely create higher unemployment. So really, there was nowhere left to move for the Reserve Bank, and they've certainly come out quite strongly and announced that they're going to cut rates.
Well, interestingly, Reserve Bank Governor Philip Lowe recognised that monetary policy isn't working because he met Treasurer Josh Frydenberg, and I believe they're talking about the government doing something now. The state and federal governments are going to have better economic management. They're going to have to spend money on infrastructure, and in fact, interestingly, used the words to encourage educational policies, entrepreneurship and innovation. All good things as far as I'm concerned.
Well, yes, they are, Michael, but they are a longer term journey in terms of, increasing economic activity in the shorter term. I mean, that's what monetary policy is all about, the sugar hit to the economy. Fiscal policy tends to work over a longer term than monetary policy. These will take some time to work their way through the system. They don't have the strong impact that typically lower interest rates have generally across the board. It's not all positive news with lower interest rates, but it certainly is positive news for property markets that have been suffering from a real lack of confidence. That fear factor has been permeating all markets over the last 12 months. And really, it's been a product of, clumsy, I believe, heavy-handed restrictions on housing market activity from our policymakers. And really, this has come home to roost now with the U-turn from APRA and the Reserve Bank in terms of monetary policy. They certainly got it wrong in terms of their predictions of where the next move in interest rates would be. They were roundly chorusing the fact that interest rates, the next move would be up. And now not only are they going to be down, but they're going to be down a number of times, it looks like, in prospect.
Well, they did a lot of this to prevent a property downturn, a property crash.
Yes.
And while we haven't had a crash, they've actually clearly created a downturn. So just to clarify what you said, APRA recently spoke about reducing the interest rate buffer that banks have to put in. So back in 2014, they started their macroprudential controls. When you think about it, that's actually 4 years now, Andrew, almost 5 years. It's been a long, long time. We sort of got used to that. But what they said at the time was borrowers were required to prove they could meet repayments under higher actual interest rates than what they're being approved for their mortgage. And that made sense. It was a sort of a stress test, but it made more sense in an environment where it was possible interest rates were going up. Doesn't make sense today. So rather than the minimum 7% interest rate hurdle for prospective borrowers, banks are now going to be required to assess individual borrowers. They can choose their own assessment rates, but they're saying it's got to be a minimum of 2.5% higher than the current rates for the loan the lender's going to get. Andrew, I see a few issues with this. First of all, APRA said they're going to consult with the banks about this new buffer for a month. So it's not coming in straight away, but at least it's a good signal. But I believe it's going to help home buyers, and it's probably not going to make a lot of difference in the current environment for investors. Let me explain. First of all, principal interest loans for home buyers are significantly below interest-only loans for most investors. So if you add that required 2.5% buffer that APRA is talking about to maybe 3.75% interest loans for home buyers, that'll make their serviceability much, much better. They're going to now measure their serviceability at something like 6.25%. But if you add 2.5%, which is higher than the current increase in the current stress buffer at the moment for investors, even if interest rates come down, they're probably still going to be assessed on their serviceability at 7.25%. So it'll help a segment of the market, and that's good, but it's not going to help everybody, Andrew.
Well, the problem, Michael, of course, is that when you set a fixed target or a fixed ceiling, you're not accounting for the proportion that may represent as interest rates fall or as they rise. Because, if we got as a result of perhaps a very significant shift downwards in economic activity, the need to push interest rates down below 1%, then, that 2.5% is going to represent a large proportion of what may be 2% mortgage rate. It should be, if they want to have a risk management buffer, they should do it as a proportion of the interest rate that's being offered, rather than set a fixed amount. This is how APRA got into trouble in the first place. They've overmanaged risk. They're setting targets which may or may not be appropriate to the changing dynamics of macroeconomics. And really, again, this overmanagement of risk, which tends to create the very outcomes that they're trying to offset, again, just leaves you scratching your head in terms of this market interference that has become policy of the day for particularly financial regulators and banks and the RBA over the last 3 or 4 years.
Well, I remember, as we've been having our chats over the years personally and at our seminars and now in these weekly shows, you've always been against interference in the free markets. And when people poo-pard you, you've actually been shown to be right. Be aware of unintended consequences, Andrew.
Yes. Well, that's right, Michael. And I think that we don't have a free market in terms of the total dynamics of our housing market. I'm not a free market guru to the nth degree. I mean, we are remarkably fortunate in this country to have a very rigid lending environment. And that's courtesy of the strong market power that the 4 banks have. And that means inherently they don't have to take risks because they still make strong profits, because, like it or not, there's not a lot of competition between banking products. As I said, I'm not a complete free market libertarian in terms of our housing markets, but I do think we have a good balance institutionally and structurally in the most important part of our market, which is the provision of finance. And let's just leave well enough alone. And as I'm saying now, Michael, if it ain't broke, don't fix it.
Well, all this is bringing consumer confidence back. Today, the Roy Morgan ANZ Bank Consumer Confidence Index came out, and it's showing that the election results, the increasing stock market, the lack of uncertainty is creating better consumer confidence, and that's good for our economy, that's good for our property markets. So I'm not ready to call a turn in the market yet, but it's going to happen sooner rather than later.
Look, I think another important factor, which is a positive, which would have been a negative if we had, I believe, a change of government, which would have added to uncertainty and doubt, is that we've now got the winter market coming up, Michael, the typically quieter, particularly July hiatus in the market. I think this will give us a rest from the negative narrative that's infected the market over the last year or so. I think that'll give buyers and sellers an opportunity to take a bit of a deep breath, to regroup. And I think the prospects of a better spring, a rising spring, are much better now, are much more positive now, particularly this week with what's happened, than we had of sightbound. And I'm getting more confident that we will see the bottom of the market this year. So green shoots were already starting to appear, but certainly off a very low base. And I think that we'll start to see a rise in market activity. Hopefully our economy will stabilise to some degree, notwithstanding those higher unemployment rates, with increased confidence. And as I said, I think it's a much better story, much better picture, much better outlook for the housing market this week than last week.
But not everyone's going to be happy, Andrew.
No.
The doomsayers are going to be proved wrong again.
But I guess their get out of jail card, Michael, will be, well, we didn't predict interest rate cuts. We'll still hear, well, it didn't happen this year, but you wait till next year.
I'm still waiting, Andrew. I'm still waiting.
Yeah, and been waiting for a long time, Michael.
Good. Okay. Thanks again for the chat. It's been another interesting week in property. We'll be back next week with our regular weekly Property Insider show. Thanks, Andrew.
Thanks, Michael.